Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be discussing the IV surface and various ORATS indicators in the dashboard. Matt, do you want to share a screen and get us started?
Sure. Thanks, Tyler. Yeah, so we've had a sell-off, lots going on in the market, lots going on internationally. Strait of Hormuz, is it blocked, is it not blocked? So one of the questions that I think that option information can help answer is, when is the worst going to be over? And we'll do that by looking at some prior corrections in the market, and we'll look at a few of the numbers related to option information. I mean, the option market is a lot more liquid than the stock market. If you knew something was going to happen, you would go into the option market because of the liquidity. So we can get some clues there on, when this might be over. And so that's the approach today, Tyler.
Great. So we're going to look at a few different types of indicators, proprietary ORATS indicators that can kind of help us get those signals.
Exactly. So we're going to use the optimizer graph just because it can, you could like scroll in and scroll out and see a lot of the crashes and such. So you can see there's a candlestick chart that's a little bit faint behind here, and then I have a short put spread. It's strategy that many option sellers might have on, and we could see the profit, and then we have what's called the profit equity line if you only used certain signals. So that's typically how the optimizer works. This is going to be slightly different. We're not really optimizing the returns here, which we want to avoid the bad and kind of have a signal and see when this thing is going to be over, when it's safe to go back in the pool. So that's what I'd like to look at today, Tyler.
Gotcha. So you're just using the optimizer as just a graph, a viewer of sorts.
And viewer, but you could also identify. So like we would typically pull up this strategy. We like to have strategies that are in the market most of the time, and then we can apply a lot of these. That might look a little bit mumbo jumbo here, but these are important ratios at in the popular side. So we're adding data sets to negotiate through, like to say, okay, when this particular, like when implied volatility is trending up, and the moving average goes above, of the 10-day goes above the 50-day, then exit the position, enter the position when volatility comes down. That's what these kind of numbers are in general relating to. We have this, right. And then we've talked about it before here a few times, but the p-value is the probability that the signal that we're getting is due to kind of happenstance or randomization. So these are very high, but still I find them, quite useful. So we're looking for, under 0.1, and these are up around 0.7. And all the, basically what that means is, the strategy that we're looking at is basically very related to a long stock or long delta. So it's very difficult with option information to be able to predict with high certainty profitability of stocks, because there's so many things going on that options don't see. But again, what we're trying to do here is make a determination if is the worst over, did some of the, and what are good ways to kind of be alerted to when these market dislocations or corrections occur. personally, I was on a different podcast network, and I said it's starting to get a little jumpy here. Like some of my indicators that I watched were showing that there's problems in the market. At that point, I started to buy more and more puts. Now, so I have a lot of puts right now, and I still have them. Is kind of the upshot here. So we're gonna look today at when these signals go off, what we could use to determine when we want to be getting back in the market. This is, and so I'll try to draw some pictures and such. So we've had a few corrections. I mean, so here's a correction here. This orange line stops because we haven't updated the back test that far yet, but you could see a correction here. You could see a correction here. Small correction here. Bigger correction here. So there's quite a bit that we could look at. So this is nice. So but this is, back to February 19 and COVID, and we could go back a little farther. And then what I've done is I've put an indicator. One of my favorites is the ORATS HV 1 day.
Matt, could you move that, take that dragger and move that bottom chart up a little bit so it's a little taller?
Yeah, sure.
It's hard to see with our pictures in there you go.
Good idea. So I always forget about that. So, and again, this is ORATS HV 1 day. I mean, that's 1 day move, so it's gonna be exaggerated. But we should also talk about why this data is important. It's very difficult to get a 1 day historical volatility. You can't do it with close to close. You can't do it with a lot of the other, well, there aren't many historical volatility calculations. So we use the kind of the history of this. We used to do a simulation of scalping gamma and turning that into a historical volatility. And then that was very difficult because we had to have very good assumptions about when to get in and when to get out. Sometimes there are bad prints in the market, and it just took a long time every day for every ticker to get every tick. So what we figured out is there's a method, and it's the Parkinson method, that we adapted some of the inputs to make it match what we were doing on a very technical and granular level. And so now we're able to use the Parkinson method to closely approximate what we used to do and really make what we think is one of the best representations of volatility, actual volatility of the stock. And it's 1 day. So it's like, so if you do it that way, you could get a 1 day vol, which close to close can't give you. So hopefully that makes sense. And then, with that data, and then we have some, moving averages. So we could say, hey, we want to enter a strategy. So we want to get into the market when the 20-day SMA value is less than the 50-day SMA value. Okay, so that's what's going on. And we exit when the opposite is true. So we could kind of zoom in. So let's zoom in a bit here. And there's a high peak here, so it kind of throws it off. But so you can see the green is when you're in the trade. So and then when you get out of the trade is at the when the green is complete. So for example, we got out here. Here's the green, and so we got in here. So basically, what that's it's like when volatility started picking up, that manifested itself here, and this is when we got out. So does that make sense so far?
Yeah, you could probably zoom in just a little bit more just to see those that SMA line, that blue dash line.
Okay.
And you could even kind of zoom in a bunch to kind of the right side of the graph,
Right.
and kind
Yeah.
of
So
get the blip, that big blip out of the way. There we go.
there we go.
Yeah.
Oh, there we go. Okay. Yeah. So that's when it happened here, right? So this is that the green line is the 20-day, the gray line is the 50-day, and again when it turns green up here is when you get in or get out. So there's that.
So
And
what's that sort of saying? That's saying that the 1-day intraday volatility, the ORATS historical volatility is kind of going back down again, right?
right,
So it's no longer, kind of the market's no longer creeping down and volatility slowly rising. We've sort of turned a corner.
right. So what you want is you want to get in when it's green and you want to get out when it's blank here. So we're out right now. So what this is saying is, although it looks like there's kind of a confluence here, when that crosses, it's safe to get back in. So this is
Right.
what we're watching right now. So a few more not very volatile days, like we've had some not very volatile days here. So a few more of those, and this particular indicator will be green. Does that make sense?
That makes sense. Yeah.
All right. So let's just look though at, do we like this indicator? So let's zoom back out and let's look at some of the other times. So, here's the tariff, the tantrum or whatever we're calling this. So, it started getting very volatile, in February and into April even. So this lasted a long time when we were out of the market, which would have been great, right? So, but it also, we missed a lot of upside here, as well. So, you might say, well, you could probably make this a quicker entry, but so you missed a lot of upside, but you also who knows what may have happened here, right? So
Right.
it kept you out, but it got you in kind of late. Does that make sense?
Yeah, I wonder if we could change sort of the entry signal a little bit on that one in the settings, because
Yeah.
right now it's set to you're comparing the 20 to the 50. We could change the entry so that it's comparing to like the 5 to the 10 or something.
Right. Well, can we? I thought there's only one that you could do. I guess
I
you could
see.
choose this one, but yeah. So
Yeah. I see.
yeah. So there's not really a way to do that, but so just know that like when this thing started coming down, right? So the actual was coming down and below it, right?
Yeah.
So that's that one. We had a bit in 2014 that wasn't that big. Let's find another bigger one. So this is a longer protracted, like this might be one of these times when it's more protracted. So we could zoom in here and so the market started coming down in July of 23, bottomed in October of 23, and then it started coming back. We didn't get in till here. So although we missed a lot of this downside, we didn't get in very quickly, right? So but you can see there is such thing as a slope of this. So when that starts coming down, and we have a couple of other indicators to get to, but you don't want to overfit too much. But like the good thing is it's getting you out at good time. The bad thing is it's kind of getting you back in at a not so great of a time. So why don't we move to another indicator, Tyler?
Yeah.
So there are ways to find indicators. You could sort by p-value and such. I've already looked at a few, so I'm going to just get in front of this a little bit. So one of the ones that I like to look at in addition to the ORATS HV1D, is the vol of vol. Now, this is pretty similar, meaning, the volatility of the vol, is kind of what we were looking at in a bit, right? It's one more derivative outside of what we just looked at. So this, I would imagine, is going to have some similar types of identification. So this one is good because it did get us out, right?
That's quite the chart there.
Yeah.
So what's the volatility of what vol? You said it's pretty similar. Is it?
Yeah.
Are we measuring the 1-day historical volatility again?
Yeah. So whenever you have a question, just type it into Auto here, and Auto will talk to you about its. Well, that's the eyeball. Actually, this isn't right. This is the vol. So we have a vol of eyeball, and we have a vol of vol, right?
Okay.
So the vol of eyeball. So there's a better. The standard deviation. It's the 20-day historical volatility is where we get the vol of vol.
Gotcha.
So, and the other one is the volatility of the implied volatility. So, but this is, we're looking at the vol of the eyeball. So it can get very, get very messy here, but like, what is the volatility of the eyeball? So it did get us out, which is great. But again, it got us out and kept us out for a long time there. It got us out early here, but missed a lot of that volatility. So here's, a big down. This one actually got us in pretty good here. So let's just take a look at that. Let's get this one off. So here's the correction in April of 22. And it got us out, but it got us in, got us back in pretty well. So, I know it looks a little messy, but this is a great exit, right? So you exited when it just kind of broke that uptrend here, and then it started coming down. So what this said is like, the vol of the vol started, the faster one, or the blue one, started going above the gray one, and you could always check. So it's the 10-day versus the 30-day. Again, it's a measurement of the 20-day vol, so it's not as, so that might sound like a short time frame, but it's measuring a kind of a longer average anyway. So so it did get us out, but it also got us in a little bit more quickly than usual. So that actually is kind of nice. So this might be one that we could use to figure out when to get back in. Does that make sense?
Sort of. So I was just thinking about the p-value of this, right? So it's 0.88, and I know we're not looking at the p-value, but I wonder if it seems like this is kind of improving our Sharpe, because it seems better risk adjusted. Like the returns aren't super great on this new green line, but seems to be a little lower risk. Like it seems a little trigger happy on the when it's kind of getting into this. So I wonder if we could have a p-value that also measures the percent chance of the Sharpe ratio being by chance.
Yeah, improving the Sharpe ratio. But again, like this, the back test that I chose, I knew wasn't going to have very good p-values because it's so similar to the stock returns. It's a short put spread. So I knew we were, maybe we should just talk about that briefly. So if you want a higher p-value, you have to find strategies like out of the money iron condors, or those types of strategies that will be controlled a lot more by volatility levels, by skew levels, and all that. So you could get a higher p-value in those types of times, but you're not going to get a high p-value for stock movement because there's so many other things related to that. Again, I kind of brought up at the beginning of the show. So I know that you're looking at the p-value, but all we're looking at now is the question that we proposed at the top of the show, and that is the title of this is, when is this going to be over? Is this a bottom yet? So what we're trying to find is some of the more important indicators, like ORATS HV 1 day, historical volatility 1 day, and now vol of that vol, like how volatile is that? Like, and because that sometimes will be something that you like. We either want to we want to get a good measurement of when to get out of the market or hedge our portfolios, and then we want to get an indicator to get back into the market. Because it's if you're out for so long like we were on the HV, that's not that great. But this is what I'm liking about this indicator, Tyler, is it's getting us back into the market. It's giving the all clear a little earlier, if that makes sense. So this might be a good one to get back in, right? So, but let's look at some more, let's look at some more kind of market corrections in 18. We had that, but it took us a while to get back, but that was pretty ugly for a while. Same thing here. It got us in at a pretty decent level in May of 18. So this was, this was actually kind of an unfortunate one in 2015. This is kind of the year of the flash crash and all that. So we missed that one. This indicator it got it here a little bit, but the performance wasn't very good in 15. That's actually, again, this is probably going to be one that doesn't get us out very well, but it'll get us in pretty well. Does that make sense?
Yeah.
So that's 2015. Then we could go way back to, here's a 2010. Kind of got us back a little bit late there. Here's the big crash, right? So, so the market in 2007 started coming down again in May, but it really started again in October. So it had us out, which is great, but it got us back in for a while. And then but then it got us out, but it came down again. So I don't know. I think this might be a pretty good one to get back in.
Yeah.
So we'll keep that in mind for getting back in. All right, let's look at another one. I wrote them down here. So the market with volatility, I think, is an interesting one. So let's go find that. And if you want to find one, you could just go. So market with vol. Oh, I need to take this off. All right, so now we have the market with vol. So let's go back to, let's take a look at how it did. So let's just, first of all, let's just talk about what market width and vol is. And what it is it shows how wide the market is. Okay. Now this is interesting because I wonder if it's the infinite that was better. So I'm going to search this again. Let's see how the infinite is. I think it's still kind of bad. It's not doing too hot of a on this. So it's this is not a good one, right? So you could go through and see on some of these crashes, it just doesn't perform.
We're in it a lot of the time. Yeah, I mean it's very much not doing that well. Even risk adjusted, not doing that well.
Right. Yeah, so that's not a good one. So let's get rid of that one. Or actually, I would do something else. So here's the ETF Slope Ratio. Now, this one is a little bit trigger happy. We could do some other things, but the good thing is it got us in there. Let's do something here because I think the SMA might be a little bit low. So that's only 5. let's make that 10, and let's make this like 30. So we can. So that gives us a little bit wider, the signals aren't as choppy.
Yeah.
All right, so we're out here, which is great. We're out here, which is great. Now let's look at how quick it was getting us back in, or how slowly it got us back in, right? So, again, this is a little mundane, but this is what, this is what you need to do as a trader to try to figure out and use these data in order to help your trading. So I actually think this is a pretty good entry point. Obviously, you missed all that, but there's head fakes, as we call it. But so this got us in okay, right? Back in here. So you got us out a very good, at a very good point, and got us back in, at a good point. This is what you want, like this equity line right here. It's kind of what you want. So, yeah, it got us out of here and such, but let's look at some other crashes. So it didn't do too well here. So this, I would, consider this, not very good. Now ETF slope, let's talk about what that means, and let's see if auto gets it. Sometimes if you delete that. So ETF slope ratio, what I think it is, it's the slope of like the SPY divided by its best ETF. So is the ticker slope divided by its ETF slope. So that is what it is. And for SPY, the most, what it uses is the Russell or the IWM.
Okay.
Yeah.
Well, can you explain that a little bit more? Like the SPY ETF versus the ETF, the best ETF of the SPY is an ETF.
Yeah. But what it ends up showing is when the slope of it's the put call slope, right? So usually the SPY is quite steep. So when it starts to fall is actually, getting towards a market that might be a little bit, in duress or whatnot. So what that means is, and it might be better just to look at, and we could look at this later, but we would look at the, the outlook and see how that actually looks. So we could do that later. But let's just look here. So so what's happening, and this is an excellent exit. It got out of here, but it's it's pretty trigger happy. Like it's missing some, but it's it had a good exit here, right? So basically what it's saying is when the SMA 30 or when the 10 when it gets shallow. So what's happening is you'll notice here that the SMA 10 is falling below the SMA 30. So you're kind of going along, and what's happening is the slope is getting shallower, and we could see this on other graphs, but the typical state for the SPY is a very steep slope. Like vol is low, and the slope is high because they're still buying puts. So it kind of goes up. When the market gets volatile, it flattens out a little bit.
Is that because people are buying less coverage during, sort of very stable periods, and then they start to hedge their portfolios by buying more puts against the SPY in more volatile periods?
Yeah, it's a few things going on at the same time. So in stable periods, the volatility all comes down, right? But they're still, but they're still buying puts, and the way that we measure it tends to spread out because we use delta along the x-axis. So so what happens is it looks very steep, and it is very steep, meaning they're paying high vol for a low dollar amount. So like, you know, it might be 50 cents or 35 cents, but the volatility might be still 40 in the way outs, in the tails, left tails, you know, so that's why that gets pretty steep.
Gotcha. Why wouldn't you just use the slope indicator then?
You could, but this is, then we could look at that, but this has more information in it. This means, you know, this is kind of, you could also use the underscore C. Underscore C is the component weighted slopes. And that's what I like to look at. And as a matter of fact, why don't we use that opportunity now to kind of go through. So I like to go click up here, and then, you know, I want to go to the outlook here for SPY. And so what we're looking at is the slope, the put call slope. And what we're going to look at is, this is Apple. Let's go SPY. What we're gonna see is SPY versus the components. And what we want to look at is, you know, what is happening. Like, so here's the slope, right? So right now the slope has come down. Okay, so this is not good. This is a positively correlated measurement to the stock price. Okay, so the SPY slope divided by the component slope is, so when that, what you want in this is you want the SPY slope to be very steep. Like
right.
when things are good, you want it the high. And you want it going up. When it's going down, it's not good. So actually what I'm seeing here is now we're starting to see a little bit of, you know, it's gotten so low that it might start to come back. So this might be,
Interesting.
yeah, so this might be one of the cases where, you know, we'll watch this, but this might be that canary in the coal mine, right?
It could be, yeah. I mean, or it could be another little blip, uptrend blip there, but we'll see.
Right. Yeah. So, you know, again, so what we've seen today is the market with the volatility. Now, that didn't show too well because I think it had it flipped. It had it opposite. So trust me when I say that's a pretty good indicator. The vol is a good indicator, and that showed getting back in. So we'll watch that. It's not back in yet. The HV got us out in good time, as did the ETF slope ratio got us out at a pretty good time. But it looks like the ETF slope ratio might be crossing above. It kind of head faked here, Tyler. But
yeah.
you know, is this going? You know, you want to see it. You know, have a couple pretty good prints, as we say, before we're going to call a base on there. So you know, just to answer the question, how is the market looking? I think, you know, there are some green shoots, but it's not. We're not out of the woods yet. You know, like it's starting to look like things are calming down. You know, and also the outlook has contango that's starting to come back. That's positively correlated. This is negatively correlated, but this is coming back down. So, you know, if for the speculative, this might be the bottom. For the people that want to wait until they see more signs, it's a little early, but there's some good signs of a bottom, Tyler.
Awesome. All right. Yeah, there's a lot of great indicators to see there. I loved seeing the indicators on the optimizer chart, and it was cool to see those kind of crossing over and all the details. So yeah, it's great to look at all the different ones. I think each one tells a different story, and by looking at the different ones, we can have a much better understanding of where the market's going. So thank you for explaining that. And yeah, well, let's see where the market goes this next week. I'm curious if we revisit one or two of these indicators next week, if they'll have turned a corner, especially that slope.
Yeah, let's do that. Let's do it next week. Let's kind of check back in on these things.
Sounds good. All right. Thanks, Matt. And thanks, Tradier, for hosting us. If you guys have any questions, please ask Otto in the top right-hand corner, as we did on the show today about the indicators. But we'll be back again next week. If you guys have any ideas for shows or things you want covered, things you want us to take a look at and show you, please email us at support@orats.com. All right. Thanks, everyone. We'll see you next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.